Even though you're hearing a lot of talk about inflation, it's mostly to dismiss the concerns. And one of the main reasons that so many analysts are dismissive, and I listened to another one of these discussions yesterday on CNBC about inflation, is that the bond market is not signaling a concern. Right? So people are looking at the bond market and they see that rates are still very low. I mean, even though the yield on the 10-year has backed up quite a bit, it's still below 1%. So it's hard to say that a 10-year yield below 1% is a warning sign for inflation. After all, if investors were concerned about inflation, why would they be willing to loan money to the U.S. government for 10 years at 1%? Therefore, the bond market is not showing any signs, any worries about inflation. Therefore, we don't have to worry because the bond market gets it right. And if there was a concern, we should see the canary in the coal mine, the bond market, right? Bonds should go down because in the past, that has certainly been the case because inflation is a major concern for a lender. Part of the interest rate charged on a loan has to be the inflation expectations that are in the mind of the lender. Because when a lender loans out money and he's not going to get paid back for 10 years, he has to think about what the money that he gets in 10 years is going to buy. Because he's giving up that money today. He could buy stuff with it, but he's not. He's loaning it to somebody else. The borrower is buying stuff with the money, and the lender is going to get the money back in 10 years. Now, if the lender expects a lot of inflation and he's waiting 10 years to get his money back, he has got to be compensated for that loss of purchasing power. And the way that a compensation is paid is in a higher interest rate. So if lenders expect higher inflation, then they will build those expectations into interest rates. And if somebody wants to borrow money and not pay it back for 10 years, they have to be willing to compensate the lender for his loss of purchasing power over time, right? And of course, if the borrower also understands that there's going to be inflation, he is okay with paying this higher rate because he realizes that over time, when he repays the loan, he is going to be repaying it in money that has less value than the money that he borrowed. So everybody is looking at the failure of the bond market to reflect this, right? Because interest rates are so low, therefore investors are clearly not concerned about inflation. Except everybody is missing the elephant in the living room, and that is the Fed. And actually, there's a few elephants in the living room in the form of other central banks that are distorting the bond market. The bond market is not working the way it has in the past because the Fed is artificially manipulating interest rates. The biggest buyer is the Federal Reserve and other central banks. And when the Fed buys bonds, it doesn't care about losing money. It doesn't matter to the Fed how much inflation is because the Fed is not making a loan the way people would make a loan, right? They're not judging the investment merits of the loan. The loan is got a political motivation. The Fed is trying to affect policy. It's trying to influence the economy, stimulate the economy, prop up the stock market. That is the purpose of the Fed's buying treasury bonds. So the Fed is not looking at treasury bonds yielding under 1% and thinking, wow, this is a lousy buy. Why do I want to buy these bonds at less than 1% and hold them for 10 years? We're going to take a big loss. The Fed doesn't care about losses. I mean, the Fed doesn't have to work for its money. It creates out of thin air. What do the guys at the Fed give a damn how much they lose by buying these low-yielding bonds? And so when you have the Fed in the market, the whole thing is distorted. And then the Fed's big presence in the market also sends a lot of speculators into the bond market. And these speculators are just buying for the short run, right? Because whenever there is a sell-off in the bond market and you see a back up in interest rates, like we saw recently, what happens? Speculators who can borrow money real cheap, also thanks to the Fed, come into the market and buy the dip. Why do they do that? Because they know they can sell to the Fed. They can flip the bonds back to the Fed because the Federal Reserve is trying to keep a lid on long-term interest rates because the economy is so loaded up with debt. And again, thanks to the Fed, that the Fed has to keep interest rates at rock bottom so people can afford to pay. Also, the Fed is trying to maintain these excess stock market valuations, and key to the overvalued stock market is the overvalued bond market, because we keep comparing stocks to bonds. And so to make that comparison favorable, the Fed has to keep the bond market propped up and keep interest rates down. The speculators know this. So they come into the bond market and they buy, not because they think it's a good long-term investment. They're not going to hold these bonds to maturity and clip coupons for 10 years. No, they're buying to flip to the Fed. So they're short-term speculators. So that's what's going on in the bond market. You have speculators that are front-running the Fed and trading, who have no intention of holding to maturity. And then you have the Fed, who will hold to maturity, but doesn't give a damn about how much they lose, because it doesn't matter, because it costs them nothing to print Federal Reserve notes.